Hi traders, welcome to this 𝖢𝖥𝖣yi Academy video, intermediate part 2 of 3. In this video, we'll discuss pivot points, what is a breakout and what is a fake out in the markets. Pivot points are technical analysis indicators used to determine the overall trend of a market and can be used for entries and finding targets. Pivot points are derived by using the high, low and closing prices from a previous trading period. The primary or central pivot point is an average of these three values. Once the main pivot point is calculated, you can determine the subsequent support and resistance levels. They can be used in trading in various different ways. First, it can determine trend. As the image shows, the main pivot point is highlighted by the white line, stepping lower with price. This tells us that the market is in a downward trend and that it could continue. Conversely, if the white pivot line was moving and stepping higher, it would tell us that the market was in an upward trend. Another way to use pivot points can be if the current price is above the main pivot point. The buyers for the day then could be bullish. Conversely, if the price is below the main pivot point, the buyers for the day could be bearish. You can see in this example here that price is above the main pivot point and price rallies, stays above the pivot point for the day. Traders use the calculated S1, S2, S3 and resistance R1, R2, R3 levels as potential entry and exit points. For instance, in a bearish market, if the price retraces and approaches the main pivot point but does not break above it, a trader might consider it a good entry, expecting the price to find resistance. So for instance here we have a consolidation at the main pivot point, we break down, price then comes back, retests it. This is usually a good area for traders to enter the market, and then price drops all the way down into that S1, even beyond it. Potentially could be then seeking the S2 support. Moving on to what is a breakout. So a breakout refers to a situation where the price of a currency pair moves beyond a predefined support or resistance level with increased volume. In simple terms, when the price of a currency pair moves to a level where it hasn't been recently, it's considered to be breaking out. Genuine breakouts often come with a spike in trading volume, and momentum oscillators like the RSI or the MACD can provide additional confirmation. After a breakout, the price often comes back to test the level it broke from. This level then becomes either support or resistance, and you can see in this example here we have a consolidation here, like a little bit of a range going on. Price breaks out and forms a close below that range. Price continues to move lower. The opposite sort of situation to that is what we call a fake out. Now, a fake out is when the price of a currency pair appears to break out beyond a level of support or resistance, but then reverses direction soon after. Essentially, it's a false breakout, so deceiving traders into believing that a substantial move is underway. Now, fake outs don't tend to last very long, and the price will reverse direction shortly after breaking the support or resistance level, and typically the volume during a fake out will be inconsistent or lower than average. This is a really good example here on the Australian dollar versus the US dollar. We had a long-term daily range here. Price broke out and down through that daily range. Many traders would have expected price to continue to move lower, but instead we ended up reversing and price came back within the range and even beyond to the other side of the range. So in summary, what have we learned today? Well, we've learned about pivot points, how pivot points form, how traders can use them as support and resistance levels. We've also learned that what is a breakout and what is a fake out, and understood that it's volume between a breakout and a fake out that can mean the difference between the two. Thanks for watching the 𝖢𝖥𝖣yi Academy Intermediate Part 2. I'll see you in Part 3.